All right, let's dive right into this comprehensive explainer, breaking down Sony's FY 2026 financial health and strategic positioning. We're really catching the company at a fascinating moment right now. I mean, they're navigating this incredibly complex global market, executing massive structural shifts, and basically redefining what success looks like for their biggest divisions. If you want to understand where this entertainment and tech giant is actually heading, you really have to parse the numbers and look at the core business narrative driving them.
We've got a great roadmap for this explainer today. First up, the FY 2026 financial snapshot. Then, gaming in the pivot to profitability over MAU. After that, semiconductor market positioning, followed by the spin-off and stock split, and finally the FY 2027 financial forecast.
Okay, kicking things off with Section 1, the FY 2026 financial snapshot.
Wow, just look at this number. Nearly 1.45 trillion yen. That is Sony's operating income from continuing operations for the fiscal year that ended March 31, 2026. This marks an absolutely incredible, record-breaking year for the company. To generate that level of operating profit in a global macroeconomic environment that's been, well, anything but simple, that really speaks to the sheer resilience and pricing power of their whole multifaceted business model.
Now, when we break down the consolidated figure side by side, a super clear narrative starts to emerge. We're seeing strong top-line sales growth, reaching roughly 12.47 trillion yen, which is a solid 3.7% bump. And then there's that brilliant 13.4% jump in operating income we just talked about. But notice the bottom line here. Net income actually took a slight dip of 2.8%. So what does that tell us? It's the story of a company aggressively driving operational efficiency and core profitability, even while taking some hits from broader market costs and strategic impairments that inevitably drag down that final net figure.
Moving right along to Section 2, gaming, and this fascinating shift toward profitability over MAU.
So Hideaki Nishino, the president of Sony Interactive Entertainment, dropped this quote during their Game and Network Services segment meeting, and it highlights a very deliberate, calculated pivot. For years, right, the gaming industry is just obsessed over MAU, monthly active users. It was the ultimate holy grail. But Nishino's making a pretty bold declaration here. They're officially stepping away from just chasing user numbers at all costs.
This is a total paradigm shift for their business model. The old industry mindset was all about acquiring users, even if you bled money on the hardware, just to get them in the door. But Sony's FY 2026 mindset, it's heavily focused on customer lifetime value, or LTV, and building recurring revenue. They want to make sure every new user they bring into the ecosystem is actually profitable on a unit economic level. How? By better monetizing their existing base with add-on content, network services, and some serious extreme operational discipline across their studios. Actually, they've already taken decisive action here, like recognizing impairments at Bungie and funneling development resources strictly toward key titles like Marathon.
And to protect those margins, their hardware strategy has become exceptionally firm. They absolutely still view hardware as the essential foundation of the gaming experience. But as a hard rule, they are refusing to sell consoles at massive losses anymore. As component costs have skyrocketed globally, Sony hasn't just eaten those costs, they've actually implemented selective price increases outside of Japan. And according to management, this hasn't even led to a material decline in customer demand. They're watching the market closely for sure, but the priority is crystal clear. The hardware business has to stand on its own 2 feet financially.
But hey, don't get it twisted. Even with this strict focus on profit over sheer growth, their user foundation is still an undeniable economic moat. As of March 2026, they've got an installed base of over 93 million PS5 units and a massively engaged base of 125 million monthly active user accounts. That gives them tremendous operational leverage. When your audience is that huge, even a tiny increase in average revenue per user translates directly into the record-high operating income we were just looking at.
All right, let's switch gears to Section 3, semiconductor market positioning.
Now this is where things get really interesting. The crucial metric here is Sony's absolutely impressive 40.4% gross profit margin in the semiconductor space. Based on this estimated FY25 data, a giant competitor like Samsung might be pulling in way more raw revenue, around $225 billion, but Sony is extracting a significantly higher margin from its $92 billion in revenue. It really proves their premium pricing power, especially in the highly specialized CMOS image sensor market that powers mobile, automotive, and security tech. They aren't just playing in this market, they are literally leading it in fundamental profitability.
Moving to Section 4, the spin-off and stock split. So, effective October 1st, 2024, Sony executed a classic 5-for-1 stock split. The strategic goal here is pretty straightforward, right? Lower the price of a single share so the stock becomes way more accessible to your everyday retail investor. For those of us crunching the financials, it just means all those basic earnings per share figures have been completely readjusted to account for the much higher outstanding share count going forward.
But alongside that split, they pulled off a major structural shakeup by spinning off the Sony Financial Group. And what's really fascinating is how they did it, through a dividend in kind. So instead of handing out cash, they distributed assets. If you held a share of Sony on the record date, you got 1 share of the newly independent financial group. It is such an elegant way to unlock value for shareholders using new equity, letting Sony tighten its focus purely on entertainment and tech without draining its corporate cash reserves.
And that brings us to our final section, Section 5, the FY 2027 Financial Forecast.
Their consolidated forecast for the fiscal year ending March 2027 visually reinforces the overarching theme of this entire explainer. Check out this specific dynamic. They're projecting a slight 1.4% cooling in raw sales volume, bringing it down to 12.3 trillion yen. But at the exact same time, they are forecasting a massive 10.5% leap in operating income, targeting 1.6 trillion yen. This is literally the profitability over pure growth strategy in action. They're getting leaner, prioritizing high-margin recurring revenue, and flat-out refusing to chase low-margin sales just to artificially puff up the top line.
Which leaves us with this incredibly provocative question, one that was actually posed directly by an analyst in their latest Q&A. With 125 million active accounts and this heavy shift toward engagement-driven revenue, exactly how far is Sony going to push this evolution? I mean, in 10 years, will PlayStation still be a hardware gatekeeper relying on cyclical console releases? Or is it going to fully transition into an IP-led, multi-platform content ecosystem where the console is just one of many ways to play? Management has already noted they're aggressively investing in AI to enhance player experiences and streamline development. As they adapt to what gamers want over the next decade, the answer to this question is absolutely going to define the future of global entertainment. It's a massive transition, and we should all be tracking it very closely.